Yeah, well, Brian, as you said, there are two components to the consumer confidence index. One is how consumers are feeling right now about their situation, and the other component is about how they think things will play out over the next 6 months. It's the present situation index component that fell. So people are feeling worse this month than they did over the past couple of months about their situation. It ties directly to how they're feeling about their job security and how they're feeling about inflation. Now, food inflation is a big piece of it, but that's been pretty constant at double-digit rates. It's the gas prices that have been fluctuating over this period of time. And now consumers are starting to feel a little bit itchy about their job situation as they're predicting that we're going into a recession here. So they're feeling nervous. You don't want nervous consumers to be going into the holiday season because this is the biggest component of retail sales for the year. And as we all know, this is the biggest component of our GDP. So they're not feeling great. The interesting thing here, Brian, is that it's all gas prices that have created this bouncing of the consumer confidence. It is almost directly correlated with that. You start then correlating that component with the generic polls out there as we go into midterms here, and they're correlated as well. So you see this correlation in how people are feeling and how they are expecting the election to play out.
Or how the elections may play out because of how they're feeling. And maybe that's why there's been so much attention on the SPR releases. Sort of odd timing. They say that's what it's used for. We can debate that all day long. But here's the thing I've learned about the consumer in 25 years, Steve. Probably the same as you. What they say and what they do are often different. There are still trillions in excess savings, right? Money saved during the pandemic, stimulus, PPP, wherever the money's from. People have a lot of money still saved up. And everywhere I go, seems to still be incredibly crowded.
Yeah, and you're going to all the expensive places, Brian, and that's pretty consistent. The high end, the higher earners are feeling great. Consumer confidence is strong, hasn't changed at all. It's the low end where you have a bigger component of their discretionary spending going out to food and gas and those kinds of things. So I think you see a direct correlation, based on all of that. But you're right. The question is, how are they going to act? And that isn't always the same. And it could change. If gas prices are able to come down, supply increases, whatever happens here, this flips on a dime. And consumers are very reactive to this thing. So, it could just be fine. But, retailers here are stocked up and they're a little nervous, Brian, because if you're going into a season, you got all your inventory. And, if it doesn't sell, you're going to have to start clearing it very early and your margins are going to get hit.
Well, it's fair enough. By the way, you and I need to hang out. I think you might be surprised at some of the places that I end up in northern Wisconsin and the Upper Peninsula of Michigan. But that's a whole different story, Steve. That's off the record. What is the biggest risk to the consumer? Is it continued inflation or is it the job market? Because the job market's been red hot. You can name your price. That appears to be rolling over right quick.
Well, the interesting thing is most recessions are accompanied by huge job losses, and so there's a lot of pain. This is an interesting one because we're still sitting with 10 to 11 million open positions. Now, as a CEO, what you do is you try to batten down the hatches going into a recession. You stop hiring. You at least freeze things if you don't, actually take action. So there are a lot of job openings that can be cut before you start cutting into jobs that are occupied by people. So could be a very odd recession where, it's relatively shallow. It's Fed induced, but you have a job full recession, which means the consumer pain isn't quite as much from a job standpoint, but it then depends on what happens with the inflation component of consumer spending.
Yeah, and you do wonder also about wage inflation, how sticky that is, because how much you're going to pay somebody to do something, and if you keep them on board, you're going to have to compensate for their pay with what you charge. And, there's this whole camp of people out there saying, oh, you can't find people, just pay them more. Okay, to those people I say, you know what? Open a pizzeria, pay somebody $50 an hour. You're going to have to charge $100 for a pizza. See how well that goes.
Yeah, it doesn't go well. And, in our wage survey, what it's saying is that CEOs expect to raise wages by about 3 to 5%, on average 4%.
Yeah.
But that happens, in the March kind of time period. So a lot of stuff can happen between now and then. If things are dropping, if things are starting to look a little itchy, that could come way down as well. And that's a big component of inflation as well, as you know.
All right. Good discussion.